Okay, sorry. Okay. So what's your name again? Sorry. Sam. Like what Sam said, this set of users are those that provide financial resources to the company. Without them, the business cannot exist. And that is why we need to direct the provision of the information to them. And if you remember, the key objective of the Financial Reporting Council of Nigeria is to protect these people, to protect the interests of investors and other stakeholders, but majorly the investors, because they are the ones, because of them we are providing reports. And that has been confirmed by the conceptual framework. Nice one, nice one. And the final one is to do what? To enable them make decision about providing resources to the company. So if they ask us that, what are the decisions that the primary users make with the financial information? It's already here. They want to make decision about what? Providing resources. But in the exam, you might be required to raise like 4 points or thereabout. So how do we raise the 4 points? How do we raise the 4 points in the exam? Decisions that the primary user make. Number one is what? Whether to buy or sell the company's what? Shares, or the entity's shares. That's a major decision. And who wants to make this decision? The investor, majorly. So by the time he sees your financial information, he will make a decision whether he wants to continue to buy more of your shares or whether he should just exit and sell your shares. Not only that, he wants to make decision on how to vote. During annual general meetings. He wants to make that decision how to vote, whether he should vote against the existing management or for them. So with the financial information he has, he would be well informed on how he wants to vote. And the third one is they want to make a decision on whether to provide loans to the entity. They want to make that decision. And who makes this decision? Majorly the lenders. Should I continue to give them loans or not? And again, and these are made majorly by the other creditors, whether to continue to provide trade credits to the company. Majorly, primarily, these are the decision these guys wants to make with the financial information you give to them. So from there, they will see a lot of things, because from what you are giving to them, they will be able to see how you have managed your resources, how you have converted it to income, the level of obligation you have. Do you have sufficient assets to cover your obligations? Then they'll be able to make all of these decisions with the financial information. So that's chapter one. Any question on chapter one? Yes, sir. It's not clear. So which is how to vote during annual general meeting. So majorly that's for investors, right? They are the one that determines whether they should reappoint the directors. They are the one that approve dividend in a company. All those things they approve during AGM. So with the information that you provide to them, they will know how to vote. They will be well informed. It is the shareholders or the investors that approve dividend. Is the shareholders or the investors that approve major capital projects that the company wants to embark on. So when they have this information, they will know how they want to vote, whether they should vote for or against the existing management in terms of the decision they want to make. That's what that point is talking about. Good question. Any other question? You have a question? You're clear. Okay. Now let's go to chapter 2. Okay. So chapter 2 talks about the qualitative characteristics of a useful financial report. Is this one that they ask often? This chapter 2, even last night was there. They ask it as often as possible. And this is the second one of the conceptual framework. That when you are preparing your financial reports, these are the attributes that financial reports must have. These are the qualities you must have. And what are they? So categorically, there are two. There's a fundamental and there's the okay, so there is the fundamental characteristics and there is the enhancing characteristics. So the first one, which is the fundamental, what it simply means is that if it has these characteristics, it's going to make it useful or not useful. So if it has these characteristics, then it will be useful. If it does not have these characteristics, then it is not what? So this is very important. It's either you have it or not. So if you don't have these characteristics, that is not a financial report because it's not useful. If it has it, then it's useful. But this one, which is the enhancing characteristics, this one makes it either even more useful. It will enhance the usefulness. It makes it more useful to the user, or it makes it what? Less useful. If it lacks these characteristics, is either it makes it more useful or it makes it less useful. Okay, so let's go to the one that makes it useful or not. So this one, they are majorly two. Thank you very much. Relevance and what? This is what makes it, is that useful or not? Relevance or faithful representation. And this one, understandability, timeliness, verifiability, and what again? Comparability. Okay, so these are the characteristics that we are going to quickly talk about. So the way they will ask it, they have asked it in the exam that for 10 marks, I think that was 2021, for 10 marks, that you should list and explain the qualitative characteristics of a useful financial report. So that diet, they wanted you to explain all of this. But in some other diet for 7, for 6, for 8 marks, they'll just say list and explain relevance, faithful representation, comparability, and understandability. So they can ask it whatever way. And we never can tell. They can ask you should list and explain the fundamental characteristic. So however they go, you should be able to explain it and give it to them. So let's start with relevance. Relevance. I was trying to avoid it, but sorry, give me 1 minute. 1 minute. Okay, so let's start with relevance. Now, when we say the financial report must be relevant, what it means is that that financial report must must be capable of making a difference it must be capable of making a difference in the decision that is made by users. Then it is relevant. Okay? I'm sure everybody has a smartphone here. So yeah, it is extremely relevant. If you know what happened before the smartphone era, you know this is extremely relevant. Another thing that you should be able to relate with to understand relevance is Google Map. Maybe for me, now even if I know where I'm going, I use Google Map. Why? Because I'm seeing that it's so on point. If it tells me that I will get to this place in the next 40 minutes, I actually get there in 40 minutes. If I want to go somewhere and I have the mind of saying this is where I want to pass, by the time I put it on Google Map, it will tell me if I pass this place, so it's 2 hours. So, but if you go through this place, it's 40 minutes. I'll quickly change my mind. So it's extremely relevant. So anything that's relevant must definitely what? Make a difference in your decision. Is either it strengthens your decision or it changes it. So it must be capable of making a difference. And from what the examples I've given you, you will see that making a difference has two qualities of value. One is predictive value. Predictive value. Anything that will make a difference, you must be able to use it to make prediction. That if I do this, this is the result. If I don't do this, this is the result. So relevance must have predictive value. Two is what? Confirmatory, confirmatory value. Meaning that you should be able to use it to confirm your prediction. So when it comes to relevance, predictive value must be present and confirmatory value must be present. Um, Let me jog your mind a bit. Maybe some of you are familiar with financial statements. Maybe, I don't know. Let me just ask you this. How do you think we can present financial reports to make it have predictive value? And maybe I'm not sure they can ask it here, but they could. That how can we present financial reports that it will have predictive value? Or yeah, fantastic. She said that by making yearly comparison. That's fantastic. That's so fantastic. So what she has said is this: to achieve predictive value, that means you must provide comparative information. That's fantastic. And if you look at all financial reports today, if they are presenting financial report for 2023, you see that they will give us that of 2022, right? So what that does for us is that it gives us like a trend. And when we can see trend, we can predict into the future. So if in year one it makes 10 million, year two makes 12 million, we can say year three can make 60 million, right? So comparative information can help us achieve this. What other ways? What other ways do you think can make us achieve predictability in the financial reports? Can make a financial report has predictive value? They can ask you. Do anybody have any other idea? Okay, let me help you. Another idea is this: providing information about discontinued operations, right? What I'm saying is this: if you plan to discontinue a segment of your business or a branch of your business that you want to discontinue, you have to present that segment separately, separate it from other segments. So IFRS, there's actually a standard which I will teach you that talks about that on IFRS 5. IFRS 5 says that if you intend or if you have discontinued a segment or a branch of your business, you have to prepare your statement of profit or loss in a way that would show continuing operations and discontinued operations. That will help us in predicting, because from there a reasonable person or a user will say that okay, they are discontinuing this one. Is it that they are having a problem? Let me quickly go and sell my shares. Or another user that knows them so well might say that eventually they have discontinued these unprofitable segments. This is good. So then they can predict your next line of action. So providing information about discontinuing operations. This can help us or help the financial reports have predictive value. Another way, or how we can present financial reports to have predictive value, is providing information on what we call non-current assets held for sale. Non-current assets held for sale. This one too, you will learn it under IFRS 5. That when an entity wants to sell an asset that ordinarily your intention is to use it, you now change your mind that I'm not using it again, I want to sell it. IFRS 5 says that you must present it separately. Separate, let the user know that you want to sell this asset. That helps in predictability, because a user will know that they are selling their assets. Is it that they are having problems or whatever? So you can predict into your future and say, okay, what's the next line of action? That's another way a financial report can have predictive value. Another way it can have predictive value is if um, providing information, giving us giving us information on one-off material transactions. A transaction that just happened this year is not something that will happen again. So those kind of one-off transactions, you need to separately present them clearly so that user will know that this income that we have this year, it won't happen next year. It's just like what is happening in Nigeria today with the naira devaluation. A lot of companies are going to book a fair value loss or an exchange loss. A lot of companies. We are waiting. So some of them, the naira devaluation happened this year. So by the time they are bringing out Q2 results, you'll be seeing huge exchange losses. Huge. Because exchange naira lost almost 55% of its value from the official rate of 400 and something. Now, as of Friday, it was 815. 815. So though where it could balance up, but Q2 result is going to be something else. So you see, those kind of loss, you need to present it separately so that user will not judge you because of that. If you don't present it clearly, they might think that this is not a good business. But by the time you tell them that okay, this is an exchange loss and the reason is because of this one-off whatever, so they will know, they will be able to predict and say no, you will still do better because it can reverse. Another one is that if you make a gain on selling an asset, maybe you sold an asset, you now make a huge gain, you have to present that because it's just a one-off. It's actually a one-off item. Another one is if you revalue an asset, okay, and you have either a revaluation surplus or a revaluation deficit. You see, those are one-off items that can impact your profitability. You need to let us know and separately present them because it helps in making what? Prediction. So for this one, I mentioned foreign exchange loss, Abi. I mentioned gain or loss on disposal. I mentioned revaluation. I mentioned revaluation surplus or deficit, predictive value. A corporate reporting, this is how they ask them question, but at your level, they don't really go this deep, right? They majorly might ask you to explain relevance and they will stop there. But you never can tell. The way ICANN is evolving these days, they are asking more practical questions. So if they ask you how financial information or financial statement can achieve predictive value, this, this information must be provided clearly to the users. Comparative information, like what my friend said, discontinued operations presented clearly, non-current asset held for sale presented clearly, one-off material transactions presented clearly. All of those help predictions. Now, you see, confirmatory value, just this one is just that whenever we make prediction, the financial statement must be able to what? Confirm in the future. So this still comes back to confirmatory comparative information. That if we say, okay, next year they will make 10 million for my own prediction. If next year come, you should be able to see it whether they make 10 million or not, right? So predictive value, confirmatory value. Finally, on relevance is materiality. This is under relevance. There is no way in reporting we want to talk about relevance and leave materiality out because materiality can make the financial report irrelevant or not useful. And you know what materiality is. Materiality, an item is material if its omission or misstatement would influence or affect the decision that the user make on that financial report. So any item that if you omit it or you misstate it will affect the decision of the user, then you know that that item is material. You don't want to joke with that kind of item. You'd present it as accurately as possible because it can affect what? Relevance. So this one is just saying that take care of materiality. Items that are material must be presented separately and accurately. Okay? And that is what this is saying. And that is relevance. Now, let's go to faithful representation. Faithful representation. Now, what this is talking about is that your financial reports must present what it purports to represent. Said the financial statement must what? Must present what it what? It purports to represent. Okay, so what we are saying here is this. If you present assets as 10 million, that should be your representation. So this is just saying present accurately. And this is similar to this fair presentation is similar to what we call true and what? And fair view. It's similar. Just prepare to present to us what you represent. Let your financial report be your representation. It should not be any other thing but your representation. But the question is, what is your representation? Your presentation is your economic activities. So if you check my note or in the conceptual framework, it said that the way it said a financial report is an economic phenomena in words and numbers. An economic phenomena in words and number. What the conceptual framework is saying there is that a financial report should majorly report to economic activities. Economic phenomena is your economic activities, what you have done, your resources, and all those information. That is all it should be. It should be your representation. Now, when you want to achieve that, three things must happen. One, you must present your economic phenomena. You must depict your economic activities completely. The information you provide must be what? Must be complete. And two, it must be neutral. And three, it must be free from error. And you know what complete is? This is simply saying that all relevant information must be provided. All relevant information, all relevant description must be provided. Neutral is that not to be biased. Yes, because management are always overly optimistic about their results. They believe they can break mountains, they believe they can achieve the unachievable. Like Nigeria now, we have hardly achieved our revenue targets. And the deficit, our fiscal deficit, we are always going above it, way above it. Well, this year maybe we might not. I think we are looking at like around 16 trillion deficit. Hopefully, we will not go above it because of the naira devaluation, right? So naira devaluation will make the revenue to actually pump up. Okay, now for a financial report for a company, you cannot be biased. You have to be neutral. And where the bias comes in for quoted entities is that analysts will have make predictions that in Q2 this company will do this kind of profit. They will achieve $10 billion. And by the time management are seeing that Q2 is getting over and we're not doing even up to $5 billion, then they want to pad and all of that. So we are saying here that you have to be neutral. Don't look at what they are saying. Report your economic activities and nothing beyond that. Okay? And that's what neutrality is talking about. Not to be what? Bias. Majorly. And finally, it's free from error. This free from error doesn't mean that the financial report should be accurate. It cannot, financial report is not accurate. It cannot be accurate. It cannot be an exact depiction. It cannot. What we are saying here is this: for it to be free from error, is that all your models, all your calculations must be properly disclosed and explained. Okay, so if you have a figure of assets that you got of like let's say 10 million, you need to explain it to us what happened. That is free from error. If you have a fair value deficit or fair value reserve of 10 billion, you need to explain to us what gave rise to that. That's free from error. It's just explaining. I think I wasn't prepared for this. Okay, so yes, don't make mistakes and all of that, but we know that financial report cannot be accurate, but try and explain what we need to know. Now, this is faithful representation. So in explaining faithful representation in the exam, what we need to really know is that you explaining completeness, neutrality, and what? Free from error. Okay, so when it achieves these three, then you will have faithfully represent what it purports to what? To represent. Now, beyond all of that, there is this that has to do with faithful representation. Because the standard says that substance over form. Transaction must be presented in accordance with their substance over form for it to be for it to achieve faithful representation, right? And substance over form is a common term in accounts in reporting. So has anyone heard of substance over form before? Here, who said yes? You. What is it?
Under accounting convention.
Under accounting convention. But what is it? What is substance over form? You're raising up your hand? No, she was 9. Okay, who wants to try? Substance over form. You want to try? No. You want to try? Substance. Eunice, I want to try. Substance over form. Tell me, what substance over form?
Financial and economic realities of transaction are not the legal form.
Okay, so it said that financial statements must provide the financial and economic reality of a transaction and not the legal form. Well, it makes sense, but
I think I am trying to remember, but what I can remember
okay.
from the last time, say for instance, you have somebody owing you maybe 5 M, and the cost to pursue that money supersedes is over 5 M. I I'm just trying to relate it. That's the explanation.
Okay, okay. So that's around cost constraints.
Let me
Not
try.
likely. Okay.
um, Capturing all the events in accounting, leaving the or whether you've collected the money or not.
Okay. Capturing all the events, whether you have collected money or not, that's accrual, not substance over form.
Well, it means reality over legality. That means financial information must be real, must be economical and legal, something
Okay,
like that.
okay, okay. Reality over legal, similar to what he has said. Any trial?
Let me just my criteria is um, like rather than somebody is owing, maybe somebody is promising you maybe oil way. Rather than saying it's oil way, you should give it the substance. What's the value of the oil way?
Okay, okay. Knowing the value of whatever asset that you have, you want to try? You don't want to try? Okay, I think you have all made very good points. Yeah. And most importantly, some of you mentioned about financial and economic reality of a transaction over legal form. But in order to break it down further for you, the first thing is this. You see, for this substance over form, the full meaning, the full name actually is economic substance over legal form. That's the full name, really. Economic substance over legal form. So, and what this is saying is this: when we are preparing an account, you prepare it in accordance with the what? Economic substance, and not the what? The legal form. And when we say your economic substance, meaning that what you should report is your economic what? Activities. What you report in the books is your economic activities. We don't care about the ownership or the what? The title on that item, on a transaction. Nobody cares about the ownership, but what we care about is the economic activity. So I'll give you two examples. One, if you have a bus or a car that you are using for Uber, right? And this bus is not your own, but you're making so much money from it. Like the money that you are making from it comes to you. All the money, your daily earnings comes to you. Though it's not your own. I don't know what arrangement you have with the person, I don't know. But the money you are making comes to you. If that is the arrangement, you see that car, that Uber, you have to put it in your books as your what? Assets. The money you are making from it, you have to put it in your books as your revenue. So the economic activities that you are the one that is using it, you are the one that is making money from it. So as far as accountant is concerned, is your asset. That's one. Another example is this. If you rent a building, it's not your own, obviously, but you are using it for your daily activities. IFRS 16, following substance over form, says that you see that building, put it in your books as if it's your own. Put it in your books as your asset, even though it's not your own. So we don't care about ownership, legal form. We don't care about the title on an item. What we care about is the economic activities. Who is exerting economic activities on these assets? Who has the economic substance? What's the financial reality? Who is making money from this? If you are also part of those making money, so the substantial part of the money, put it in your books as your. So when we get to IFRS 16 calls a building that you rent, even though it's not your own, they put it as asset and they call it right of use assets. It's not your own, but they put it there as an asset. Another example is this. If you have an item, let's say a product, you now sold it to another party. You sold that product to another party. And the person paid you, but you are still using that thing. It's just like you sold a car. You have collected money, but you are still using it. Using economic substance over legal form, you have not sold. Because the economic reality is that you have not sold, even though legally, the lawyer will say you have sold. Or accountant will say you have not recognized that as sales. You did not sell because you are still using it. The financial reality is that you are still what? Using it. Another example is this. If you have a product that you said you sold, you now told the person, in the next 1 year, I will buy it back from you. You sold, and the guy has no option but to sell. If the guy has option not to sell, that's another thing. But if the guy has no choice but to sell it back to you, you sold. You now tell him, I'll collect it back from you, I'll buy it back from you in the next 1 year. You see, as of today, you have not sold. You have not sold because you still have the option to what? To buy back. You see, all of these things I've mentioned, this substance we're talking about is what an accountant calls control. What is important for us in account is economic substance, is control, not the legal. From owning an asset, from using an asset that is not your own, put it in your books. From renting a building that is not your own, put it in your books as if it's yours. From selling a good or a product or an item that you are still using, you have not sold. You have not sold. In fact, when we get to IFRS 15, you will learn further that when you sell to somebody, the person has paid you, but the item is still in your possession. You are still using it, not just in your possession. You are still using it. In fact, you see the money the person gave to you is a liability to you. You recognize it in your book as loan. It's just like the person gave you a loan indirectly. You learn all of that. But the bone of contention today is that understand economic substance over legal form. That everything we are going to be learning and reporting, what we are going to be reporting is the economic and financial reality and not the legal form. And I've given you like 4 examples. If you own, if you are using an asset that is not your own, you report it in your book as your what? Assets. If you have sold an item that you are still using, you do not report it as what? Revenue. And in fact, the money you have collected is a liability to you. It is a liability. That cannot be a what? A revenue. And that is a principle behind economic substance over legal form. That is what guides us. Okay, substance over form checked. Another thing under faithful representation is prudence. See, I just gave you 3 examples. In your test next week, it might be those 3 examples I'll ask you to tell me. Because they have asked in exam before that you should explain economic substance over form. They've asked severally. So it's not just saying financial reality over legal form to give you 0. The main explanation is giving them those examples. Right? Okay. Okay, now the next point is prudence.